Welcome to this explainer. Okay, I am absolutely thrilled you're tuning in today because we are unpacking a seriously massive event in the financial world. We are looking directly at Scotiabank's jaw-dropping third quarter earnings report for fiscal 2026. It dropped on August 25th, and it literally lit up the market. I mean, if you follow the banking sector, you know this kind of sudden market frenzy, it just doesn't happen every day. So what exactly did Scotiabank do to set this off? Well, we're going to break down these record numbers segment by segment to show you exactly why investors were scrambling to buy in.
So here's our game plan. We're going to look at the immediate stock market surge, break down the actual numbers, dive into the division growth, see how Wall Street is reacting, and finally, weigh the rewards against the reality of the risks. All right, kicking things off with Section 1, the stock market surge, a decisive breakout.
You gotta see this number, 5.37%. That is exactly how much Scotiabank shares rocketed on the New York Stock Exchange in a single session right after the earnings release, closing at $91.52. Now, in the banking world, a single-day jump like that for a massive financial institution is huge. During midday trading, the stock actually hit a brand new 52-week high of $92.75. And when you zoom out and look at the Toronto Stock Exchange, this recent surge brings Scotiabank's one-year gain to over 50%. We're talking about a total financial behemoth that is now trading with a market cap of over $148 billion.
And if you want to see what a blowout looks like, just check this out. It brilliantly illustrates just how decisive this breakout really was. Comparing the immediate stock moves of Scotiabank's major Canadian banking peers on earnings day, the contrast is honestly stark. Scotiabank didn't just beat the market, they completely crushed their peers. While CIBC, TD, and RBC saw, modest bumps of between 1% and 2%, and BMO actually dipped into the red, Scotiabank was up that whopping 5.37%. It was a broad-based, decisive outperformance. It basically signaled to everyone that something really unique was happening under the hood.
Moving right along to Section 2, breaking down the numbers and beating the street. The gap between what Wall Street expected and what Scotiabank actually did, it's honestly striking. Analysts were projecting an adjusted earnings per share, or EPS, of about $2.10. Scotiabank came in and delivered an adjusted EPS of $2.28. That is a massive beat, nearly 9% over consensus estimates and a 21% jump year over year. And this wasn't just some fluke either. It was fueled by an incredible adjusted net income of $2.973 billion, which itself is up 18% from the previous year. They absolutely blew past expectations. It's the kind of beat that literally makes analysts furiously double-check their spreadsheets. Which brings us to the real anchor of this whole turnaround story. On the earnings call, CEO Scott Thomson said, "We exceeded our 14% return on equity target this quarter, highlighting the improvements that we have made across the bank to increase margins and fee income." This is absolutely crucial to understand. The bank actually landed at a 14.2% adjusted return on equity, and that's up from 12.4% just a year ago. But here's the big takeaway. They hit this 14% target ahead of their original fiscal 2028 schedule. They are literally years ahead of their own master plan. Plus, Thomson made it clear, this 14%, it's not a ceiling. They expect to just keep growing.
And this next part just screams consistency. The number 10 here represents 10 consecutive quarters of positive operating leverage. I mean, think about the economic roller coaster we've all been on over the last 2.5 years, right? Yet, Scotiabank has maintained positive operating leverage through all of it. They've brought their year-to-date operating leverage up to 3.9% while improving their productivity ratio to a very lean 52.5%. Long story short, they are doing way more with less, and it is paying off handsomely.
Okay, Section 3, division by division growth. They were firing on all cylinders.
We're going to do a bit of a rapid-fire sequence here because honestly, the secret to this record quarter is that absolutely every single business segment brought their A-game. Starting with Canadian banking, this core division saw a 12% growth, raking in $1.071 billion. This was driven by record revenues and highly disciplined expense management. But the true standout here, they marked their 5th consecutive quarter of margin expansion. In fact, their return on equity in Canadian banking improved by 160 basis points sequentially, hitting a remarkable 19.4%. Basically, their home turf is incredibly profitable right now.
Looking overseas, the international banking division grew by 8%, reaching $725 million. This totally outpaced analyst forecasts, which had them pegged at only $629 million. So how did they pull it off? Well, analysis shows they successfully shifted their strategy. They're focusing heavily on making loans in their core consumer markets and systematically winding down the less profitable corporate loans overseas. It's a calculated tightening, and it's driving some very real results.
Next up is global wealth management, logging a massive 23% jump to $515 million. This was an absolute standout performer for the quarter. The catalyst, a record-breaking $3 billion in Q3 net sales, which is up 14% year-over-year. High net worth clients and retail investors are funneling money into Scotiabank's wealth ecosystem at a historic pace.
But save the best for last, right? We have the biggest percentage gainer of them all: global banking and markets. This division surged a breathtaking 37% to $647 million. Overall revenue in this segment was actually up 32% year-over-year. The engine behind this was elevated market volatility, which supported much stronger than expected trading, combined with really robust investment banking activity. Basically, when the markets got choppy, Scotiabank's trading desk brought a speedboat and capitalized beautifully.
Moving into Section 4, Wall Street analysts react. Let's look at those upgrades. Numbers like that, they force major re-ratings. TD Securities officially upgraded Scotiabank's stock from a hold to a buy. But they didn't just upgrade the rating. They significantly raised their price target from 124 Canadian dollars all the way up to a massive 141 Canadian dollars. They are clearly seeing some serious long-term value unlocked by this single quarter. To understand exactly why, TD Cowen analyst Mario Mendonca really hit the nail on the head here. He noted, Scotiabank delivered a remarkably strong F3Q, and its long-term turnaround is picking up speed. Mendonca laid out three main reasons for this renewed optimism. First, renewed loan growth across the bank. Second, lower provisions for credit losses. And third, that fantastic return on equity progression we discussed earlier, especially inside Canadian banking. And it wasn't just TD. This is a broad industry-wide consensus right now. Keefe Bruyette and Woods initiated coverage with an outperform rating and a sky-high 148 Canadian dollar target. Royal Bank of Canada lifted its target to $117. CIBC raised its target to 136 Canadian dollars ahead of the print. Taking all of this together, from market beat data, the stock holds a solid, moderate buy consensus rating with an average target of $117. Make no mistake, Wall Street is definitely paying very close attention. Finally, Section 5, Rewards, Risks, and Reality. Let's step back and look at the full picture. We always got to weigh both sides of the scale, right? On one hand, you've got shareholder capital returns, fortified by a very robust 13.1% CET1 capital ratio. That's essentially the bank's core reserve of cash. This means they have ample capacity for continued growth and buybacks. But on the other side of the scale, we have to recognize the macroeconomic risks. Scotiabank still operates a leveraged balance sheet, and they do hold elevated credit provisions. If the broader economy slows down, or if loan losses begin to rise, future profits could definitely face some significant pressure. But let's be real for now. The rewards are definitely flowing. Over the past 12 months, Scotiabank has returned 8.3 billion Canadian dollars to shareholders. In this quarter alone, they repurchased 8.6 million shares and continue to offer a $1.14 per share quarterly dividend. That results in a really healthy 3.7% dividend yield. However, impartially speaking, we have to remind you that part of this strong performance is tied to highly favorable market conditions, and those might not last forever. Furthermore, evolving trade tensions between the US and Canada remain a real factor to watch, even if CEO Thompson currently calls the situation manageable. Which leaves us with one final kind of billion-dollar question to ponder. With ROE targets hit years early, margins rapidly expanding across all major divisions, and a stock that has already popped over 50% in a single year, is Scotiabank's turnaround fully priced into the stock right now, or is this momentum just getting started? That is the big question you'll need to answer through your own due diligence as you consider what this record quarter means for the future. Thank you so much for joining me on this explainer, and I hope this helps clear up exactly what's going on with Scotiabank's massive Q3.